Hi, I'm going to give a quick overview of some of the ideas from Chapter 8. Chapter 8 covers topics related to home and automobile insurance. Actually, Chapter 8 is the first of 3 chapters that are devoted to various ideas related to insurance. The first set of ideas are home and automobile. The second, in Chapter 9, we'll cover health and disability insurance. And then in Chapter 10, we'll discuss life insurance. And in a personal finance or kind of how you plan and budget and save, all 3 topics are very important because unfortunate things can happen, and without insurance, all of your good intentions about saving and investment can change. Key ideas in the chapter. A big idea about is what is the concept of risk. I'm not going to cover very much in this lecture on those ideas, but the book covers it quite nicely. Then there's some discussion of risk management, things you can do to control the amount of risk you're exposed to. And related to that idea is the role of insurance. And that is, you're confronted with certain risk. You can take certain actions to limit, reduce the chance of bad outcomes. But if something bad happens, insurance can play an important role to protect you financially from the consequences of a bad outcome. Like, for instance, if you get involved in a car accident and you might be liable to repair not just your car, but potentially your car and the other person's car. The idea of insurance is you engage in a contract with a company, the insurance company, and for a fee, the insurance company will, under a set of circumstances, take responsibility for the losses from these bad outcomes. A couple ideas, and again, these are all discussed at more length in the chapter. One thing you want to think about in terms of managing your assets, and that's what all these chapters are about protecting assets, whether it's your home and automobile, whether it's your income, or whether it's taking care of your family after, if you have it to die, that would be the life insurance. 4 things that relate to all the next 3 chapters. One is risk avoidance. So an important thing would be to take precautions to avoid risk. Risk reduction would be taking actions to reduce risk. So, for instance, risk avoidance, if you're concerned about a car accident, you can take public transportation more, right? So you can avoid the risk of a car accident. Risk reduction would be not texting when you're driving, not using your phone when you're driving, driving defensively instead of aggressively, right? So risk avoidance and risk reduction are not the same idea. Risk assumption is the idea that the insurance company actually pushes risk to the buyer. So how would it do that? I'm engaging in a contract and I'm going to buy some insurance. What's risk assumption? Quite often in these policies, there'll be a deductible that a buyer will have to pay. All right. And so if you have an insurance policy that pays without you having to make any deductible payment, any part of the payment for the repair, you might engage in riskier behavior. So parking your car in dangerous neighborhoods, or leaving the car doors unlocked so your car stereo will be stolen. So risk assumption is the idea that the companies are going to put some of the risk on you, and that's often through the form of deductibles. And deductibles will be the share of the payment that you have to pay. So for instance, if you have car insurance, your deductible could be $250 or $500 or $1,000, right? So if you have a $500 deductible, that would mean if you have something that needs to be repaired in your car and you want to make an insurance claim, say you've had a minor fender bender, the first $500 has to be paid by you. So the deductible will be kind of the upfront payment by the insurance buyer. That shifts some of the risk to the buyer. That's called risk assumption. Risk shifting is what you do when you engage in buying insurance. You're shifting some of the risk that you might be confronted with to the insurance company. So how does this work? You'll purchase a policy, okay, so you'll call around insurance companies, tell them you'd like to purchase either home insurance or auto insurance for the purposes of this chapter, and they will offer you a certain type of policy. These policies are often quite standard across companies, and these policies are known as coverage, so they're offering you some kind of coverage for your car. What happens is that for a fee, the insurance company will assume some risk, and obviously, therefore, the price the insurance company will charge you will depend on what they believe the risk of you actually having a bad outcome. All right, so the data shows that especially males under the age of 25, have more car accidents than females. And so when male age 22 goes to get car insurance, he will pay a lot higher premium, the payment to the insurance firm, because it'll be viewed that he's a riskier driver. Typically what would happen is the policyholder will make a periodic payment, which is called a premium payment. That can be once a year, it can be monthly, it can be twice a year. Usually that's a range between you and the insurance company when you are discussing the policy. What are the types of risk you can insure yourself from? One will be personal risk, right? So you can get in a car accident and get injured, and you will have loss of income. Or in a particularly bad case, you can have loss of life. The risk can, as I gave an example, can happen from a bad outcome like a car accident. It can happen because of illness, old age, unemployment, right? Unemployment would be a certain type of risk, a loss of income. You can insure against these. Okay, property risk would be, for instance, if you have an automobile policy and your car is stolen. It also can be when you have a home insurance policy and something happens to your house. So those would be property risk. And finally, there's these liability risk. Liability risk will be when you have an accident or something happens at your house and someone else is injured. So, for instance, if you have a car accident, the other person driving, it could be that someone's at your house and they fall down your steps or they slip on your icy sidewalk, right? Quite often there's issues involving negligence. And the insurance companies are concerned that you don't take ordinary care to prevent accidents. So it's something you want to be consider when you engage in your policy, talking about what provisions allow the insurance company not to make a payment. Okay. This slide's relevant for all of the chapters, chapter 8, 9, and 10. When you think about getting insurance, you need to think about your insurance goal, how much car insurance or how much home insurance or how much life insurance you want to get. You want to develop a plan to reach your goals, okay? What exactly needs to be insured? So, for instance, if you have an older car, you might not get coverage that allows you to repair the car. So collision insurance you may not get for an older car, but you would get collision insurance for a newer car. You have to make decisions about how much you should insure it for. This is particularly relevant for life insurance and home insurance. Life insurance, you have to make a decision about how much insurance to get for yourself. What kind of insurance should you buy? When we talk about life insurance, we're going to talk about whole life insurance and term life insurance. And then who should you buy insurance from? Then you're going to put your plan into action. You're going to make inquiries, make telephone calls to insurance companies, check websites. And once you have your insurance, then there's kind of closing the loop with checking your results. So even after you have insurance, say with a particular car company for a while, you may want to change and consider that sometimes when you were, say, a younger male, one company offers better insurance, but by the time you're in your late 20s, other insurance companies dramatically change the price which they're willing to offer males insurance, and so you might find it your advantage to shift insurance companies. With respect to homeowners insurance, one of the topics of this chapter, homeowners insurance, I want to stress, is broader than you think, right? So at one level, you're thinking about your home, the building, or more broadly, the buildings on your property. So for instance, it's not just your house, it can be your garage, your tool shed, and in fact, it includes trees and shrubs, right? So you have homeowners insurance that if a branch from your tree falls on your house or on a neighbor's car, as long as you've taken proper care in terms of trimming the tree, you'll be covered. So for instance, I actually have a friend who had a huge tree and a big storm, a big chunk of the tree fell on his neighbor's house. Luckily, he had actually had the tree trimmed relatively recently, as in like a year before, so he had documentation that he had been taking care of the tree, and so it was covered under his policy. Homeowners insurance cover additional living expenses if you're unable to live in your house. Homeowners insurance includes coverage for your personal property in the house. That's an important thing. So, for instance, your clothes or your jewelry or your furniture is covered under your homeowner's insurance. It also covers personal liability. So again, as we said, injuries to other people on your property. Someone slips and falls off your deck, or just somehow injures themselves in at your house. That covers under your home insurance policy. And in some cases, home insurance, you can engage and get kind of specialized coverage. For instance, in California, many people have earthquake coverage. If you're in certain low-lying areas, you have flood coverage. This was when I first came to buy home insurance, this idea of what's called H0, H01, H02, and H03. I had no idea what they were talking about when my wife and I first were confronted with this issue about buying home insurance. So basically, there are different levels of insurance you buy. Again, much of this is common across any insurance company that you'll get quotes from. They're going to ask you whether you want H01, H02, or H03. Okay, and so as you go up from 1 to 2 to 3, more and more things are covered under the policy, and so not surprisingly, H03 policies are more expensive than H01 policy, and that's because they cover additional risk to the homeowner. Okay, what are typical provisions in home and auto insurance? There's important that you want to get a policy that offers you full coverage. This is particularly important when it comes to home insurance. Okay, so when you shop around, it is not in your interest to get a home insurance policy that doesn't cover the full value of your house. Co-insurance is a provision in almost all insurance policies that require you to pay part of the loss. I mentioned this earlier. Now, one important thing when it comes with respect to home insurance, when you're shopping around for policies, please pay attention to whether they're offering you actual cash value or replacement cost. And it may not be obvious which one's better. Let me stress that replacement cost is the one you want. If you're shopping two companies and one company comes in cheaper, but they're offering you actual cash value, that explains why they're cheaper. Actual cash value basically takes into account depreciation. So let's suppose something's happened at your house, a water pipe breaks, there's some damage inside your house, including damage to furniture and some electronics, your TV set. Under actual cash value, they're going to say, well, that was a 10-year-old sofa and a 5-year-old TV, and they're going to depreciate the value of the sofa and the TV and give you a smaller amount. That would also mean they might also give you a smaller amount, what they deem is appropriate to repair the items inside the house. Replacement cost covers the full cost to replace or repair the damaged item. Okay, and so it's actually, in most cases, you want to get replacement cost because you have an insurance policy, and then when you need it, you may find out that they're only paying 20% of the cost it would actually take you to repair or replace the damaged items. So it's kind of a surprise to many buyers. They chose a company because they had a good price. They actually chose a company with an actual cash value provision. So again, let me stress, all else equal, you want a replacement cost insurance policy. It does cost more, but again, what we're trying to do is insure ourselves from really bad outcomes. Okay, and bad outcomes would mean that your house burns down and you have hundreds of thousands of dollars in house repairs in expenses to replace items inside the house. It would really be a bad time to discover that everything in your house has been heavily depreciated by the insurance company and they're only going to pay you a small amount when it actually takes to replace the items. With respect to automobile insurance, I'm not going to comment very much in this talk. The book does cover it. Many of you already are drivers and already know something about automobile insurance. I'm just going to stress a couple of things. One is it is the law that you have to have automobile insurance. Okay. It's remarkable how often you read in the paper about someone having an accident and they don't have automobile insurance. You are facing jail time and large personal liability. If you don't have automobile insurance, this shouldn't be something that there's any second thought at all in your mind whether or not you're going to have automobile insurance. If you cannot afford automobile insurance, you should not be driving a car. You're breaking the law. And in addition to that, you're doing incredibly risky actions because it could be that you have a car accident with no fault of yourself. Someone else runs a red light, but you don't have car insurance. You're going to be in major trouble, and including major financial trouble. Okay, so I'm just going to make that statement. It's an important thing to get up front. You have to have car insurance. When you're shopping for car insurance, many of you are under your parents' coverage right now. When you graduate from college, maybe at that point you're going to be on your own and purchase your automobile insurance on your own. There are two big categories of things that you get covered in your automobile insurance. One is bodily injury coverages for you or someone else who's injured in the car accident that you were involved in. And then there's a second issue, which is property damage. And that includes potential liability for the other person's car. So you'll see on your insurance, when you're looking for insurance, they usually break out your coverage under these two categories. New Jersey and most states now have no-fault insurance. The idea of no-fault insurance was that each driver will collect from his or her own insurance company when it's not obvious, when it's not 100% obvious about the liability responsibility for the accident. It was an attempt to reduce the cost and delays associated with the insurance prior to this. No-fault insurance is not, I would say, a great outcome, but it is the law of New Jersey in most states. And so it goes back to the idea about why you need insurance, even if you're not in a major accident. Likely you're responsible for your own insurance. These are the major topics for the home and automobile chapter, and good luck.